U.S. Market Review for the week of September 2nd. I'm Chelsea Hartness in for Matt Harwell, who is enjoying an extended holiday. Stocks lost ground last month as the S&P 500, a benchmark of mostly larger companies, lost nearly 3%. It was the index's largest monthly loss since May 2012. Nonetheless, the S&P 500 did reach a new all-time high several weeks ago. The S&P 500 has gained over 16% in 2013. It was a slightly better month for balanced portfolios, though international stocks and bonds also lost ground. Losses were modest. Some international markets even had gains. It should be noted that the beleaguered commodities asset class, an important part of many balanced portfolios, posted a gain last month. The Dow Jones UBS Commodity Index, for instance, was up over 3%. It wasn't just energy prices moving higher either, as it was a broad-based rally. Lastly, fixed income prices were also slightly down last month as the Barclays Capital Aggregate Bond Index lost 0.5%. The 10-year Treasury yield finished the month at 2.78% and has now increased nearly 1.25% over the last year. Treasury yields have risen for 4 straight months. For more on the markets, including how CLS is currently thinking about the fixed income markets, let's go to our Chief Investment Officer, Rusty Vanneman.
Thank you, Chelsea. As you mentioned, it's been a rough go for the bond market over the last few months and for the last year. In turn, a lot of investors have turned negative on the asset class, even considering the notion of abandoning bonds. For example, outflows from bond funds last month through last Tuesday were the third largest monthly outflow in nearly 30 years. As for the notion of abandoning bonds, I would say, as former President George Bush Sr. said, and as Dana Carvey repeated, wouldn't it be prudent at this juncture? Here's why. First, I'll admit we share the concerns that the long-term prospects for bonds don't look great. Look at this chart of 10-year Treasury yields using annual data. Yields dipped below 2% last year. Looking at yields going all the way back to the 1800s, this is back to lows from the early 1940s, right before a massive 40-year secular bear market of consistently rising interest rates. Again, this chart is using annual data. Yields are now approaching 3%. I believe the best predictor of future long-term bond market returns is the current yield of the bond market. Given that 10-year treasuries are just below 3%, the prospects moving forward just don't look that bright. Of course, this assumes that bond returns are only about interest rate movements. That is definitely not the case. Credit risk, the risk that the bond interest and principal might not be paid, is another key driver of bond returns. This year, even though the rise in interest rates has put pressure on bond prices, taking on credit risk has benefited investors. That's why the overall bond market, as defined by the Barclays Capital Aggregate Bond Index, is down less than 2% over the last year. And that's despite the fact that 10-year Treasury yields have risen from 1.6 to 2.8%, a whopping 80% increase in yields. Nonetheless, it's not probable that bonds will provide a return anything like they have in recent years. Over the last 20 years, for example, long-term Treasury bonds have had an annualized return of just over 7%. Over the next 20 years, it's going to be extremely difficult to match that. Despite our lower expectations, we believe that bonds still make sense for multi-asset portfolios, that they will still likely generate mostly positive returns in the years ahead. Bonds still provide income. They will still provide stability to portfolios. They still typically provide some level of diversification versus stocks, especially when the stock market suffers. But what will bonds do if they enter an extended bear market like the aforementioned one that began in the early 1940s and ended in the early 1980s? You might be surprised to know that experience wasn't as bad as you might initially guess. Bonds still posted gains in 80% of those years. That was an even better result in the stock market. The worst return for bonds in any year during that time was negative 9%. The numbers improved over the rolling 3-year time periods. The worst total return for bonds was negative 1%. Far better than the negative 11% for stocks during that time. And bonds did not have a loss over a 5-year time period. Stocks did. Bottom line, bonds can still provide portfolio stability, income, and positive returns during a secular bear market. Many believe that bond yields are going to keep rising in the near future. The view that interest rates could rise has been commonplace for nearly 20 years now anyway, And if we've learned anything from investor sentiment, it's that when investors feel strongest about something, it's usually time to go the other direction. Given this outlook on fixed income, how is CLS shaping portfolios? We remain defensive regarding interest rate sensitivity, keeping our bond maturities below benchmarks. That said, some CLS portfolio managers are starting to nibble on longer maturity bonds, including Treasury inflation-protected bonds, otherwise known as TIPS. TIPS have been hammered this year, and now the inflation protection is attractively priced. We are also maintaining our preference for corporate bonds over government bonds, with a notable allocation to the bank loan and floating note asset class segments. In addition, we are still working our creative diversification investment theme, which includes carving out traditional fixed income exposure and increasing our exposure to alternative asset class segments.
Thank you, Rusty. In this week's PDF and podcast, we'll continue our month in review with a look at market sentiment, GDP growth, and what we may see from the Federal Reserve. That concludes our update for the first week of September. We hope to see you back next Tuesday. Have a great week.